Okay, welcome back to lecture 3, and this is where we'll start talking about the more technical details of the course and also start covering some of the more interesting aspects of the course as well, right? So, starting with this session and going into the next couple of sessions, we'll devote quite a significant portion of the course to studying interest rates, how they're determined, why do we need an interest rate, and so on and so forth, right? So, the 5 or 6 key elements that I really want you to take away from this discussion in chapter 3 is to first figure out how do we calculate present values and future values, right? It is the cornerstone of how we do valuation in general. So we'll talk about how do we do that calculation. Then we'll talk about different kinds of debt instruments. So once you start beginning to talk about interest rates, you need to talk about debt and how different kinds of debt instruments, different kinds of bonds will have different ways of determining what the interest rate on them is. Then there's a crucial idea of what we call yield to maturity of a bond and the price, right? So we'll talk about why there is this kind of inverse relationship between what, first of all, what yield to maturity means, what is generally referred to as the bond yield, and what the relationship is to the price of a bond, right? Once you allow the bond to trade on the secondary market, the price is going to fluctuate. As the price fluctuates, the yield that you get on the bond is also going to change, and this is going to end up there's an inverse relationship between these bond prices and bond yields. So we'll talk about why that should be the case, why there's this inverse relationship between bond prices and bond yields, and then we'll finally talk about a couple of short discussions on uh, when we think about interest rates are not the only way you can earn return on a bond. We'll talk about what the differences between the interest rate and the rate of return is. And finally, we'll talk about how do we differentiate between a nominal interest rate and a real interest rate, and why that distinction actually matters, right? That we might actually want to know what the distinction there is. But before we get into all of that, we'll start with we'll tie it back to a real world example that if you think about what a treasury bond is, when we talk about a treasury bond is any bond, a debt instrument, which is issued by the US Treasury, right? It's backed by the full faith and credit of the United States government. So you're essentially lending money to the US government, and the default risk, the risk that the US government will fail to make payment on that loan is very minimal, right? So uh, but in 2016, and that kind of analysis has only accelerated since then. We found this a lot of financial advisors, and that's what you'll find in this climate as well. We're warning investors not to buy these treasury bonds, right? Now, why would you ever considering how safe this asset is, and considering that the default risk on this asset is so low, why would why would investors not want to participate in this uh, financial asset? And the argument here is about there is a risk attached to these bonds with US Treasury bonds, which is related to what we call the interest rate risk, right? So if the interest rate in the economy changes, somehow the price of the bond is going to get affected by it, right? So, and the interest rate in the economy is going to change based on, as we discussed in the earlier session, based on how the money supply in the economy is managed, right? So if there is a lot of money supply in the economy, then the interest rate is going to fall. And if there is a lot of a lot of big increase in money supply without a commensurate increase in the production and the real economy, then that is going to result in high inflation in the long run, right? So the expectation of higher future inflation would lower the price of bonds because the interest rates on these bonds would have to go up. All right, so the question essentially became, okay, a US Treasury bond is such a safe asset. It's issued by the US government. Most people should own some portion of it. And now you are faced with a situation where financial advisors are telling investors quite strenuously that maybe it's a bad idea to be buying these bonds because there's interest rate risks attached with it. And that's the discussion that we'll focus on, right? So what that does this analysis actually make sense, that when some investment analysts argue that very low interest rates on some long-term bonds make them more risky, what is the argument? What is the underlying framework for that argument? And does that argument actually hold any merit? And more to the point, this is where we want to delve into the relationship between why interest rates and the prices of financial securities move in opposite directions, right? So what we find is that there's an inverse relationship between where the interest rates in the economy are and what the prices of financial assets are. And if you want to get a real world example of what is happening right now, if you look at what the interest rates are on a 10-year US Treasury bond, you can make maybe what 0.6%, something like that per annum. And you can see at the same time, it's accompanied by a huge increase in the prices of financial assets. So you see that when interest rates drop, the price of financial assets moves up, and they have this inverse relationship where that feeds into the other. And we'll see where that inverse relationship comes from. It's rather a very mechanical reason for why that relationship exists, but that also gives policymakers an interesting lever to push on in times of crisis to keep asset prices high. All right. So that's what we'll do. Okay. So before we can get into all of those technical discussions, we need to basically quickly understand what present values and future values are. Okay. Now, if you think about the interest rate on a loan, right? The question, it's a interesting question to ponder. Why should there even be an interest rate on a loan? Okay. The first thing is, of course, that what should this interest rate cover? The interest rate at the bare minimum should cover the opportunity cost of supplying credit. Okay. What do you mean by the opportunity cost of supplying credit? So if I have $1,000 and I don't want to spend it right now, and you come to me and say I need a loan for $1,000. Now what should the interest rate that we agree upon cover? The first of all, it should cover the fact that I could not lend this. I could choose not to lend this money to you and do something else with it. There is a next best use of every resource, and there's a next best use of this $1,000. Maybe instead of lending you the money, I could take that money and lend it to somebody else. And suppose they're willing to pay me 6% interest. So if I have to lend to you, you need to at least pay me 6% interest, if not something more than that. So in a certain sense, what we are arguing about is that if I have to lend this money out, there's an opportunity cost associated with it, because this resource has alternative uses. As soon as something has alternative uses, you can come up with this notion of an opportunity cost. What is the next best alternative, and what will that yield, right? So the interest rate on a loan should, at a bare minimum, right, give you compensation for inflation, right? So that the interest rate is taking into account how much inflation or how much expected inflation there will be in the economy. Because if prices rise, then the payments that are received in the future will buy fewer and fewer goods, right? So that interest rates needs to account for the fact that prices are going to rise. Okay, so if you and I agree that prices will go up by 2% over the following year, the interest rate that we agree upon should at least be 2%. Because whatever, if I give you $1,000 as a loan today, you need to at least give me 2% more than that next year for me to be able to buy the same basket of goods and services that I could buy, right? Because prices have gone up by 2%, you give me 2% more, right? So the first thing that interest rates need to at least compensate for is for inflation risk. The second compensation is for default risk, right? So the borrower might default on the loan, and so the interest rate needs to take into account what is the probability that the borrower is going to be able to make these payments back to me consistently, so that all of my money, the principal and the interest payments that we agreed upon, are recovered in the time horizon that we establish, right? So the second thing that the interest rate needs to take into account is what is the probability of default on this loan, and given that this is the probability level of default, what is the right interest rate for me to charge? So if that is a monotonic relationship, so the higher the probability of default, the higher the interest rate should be, because that's makes sense, and that you're getting compensated based on if the risk profile is getting worse and worse, you need to get a higher and higher interest rate in order to compensate for it. And then the third argument for why you might want why you need an interest rate in the economy is that there is what we call the time value of money, right? So as you can imagine, when we think about consumption in the present period is more valuable than for me to delay consumption in the future period, right? So it's what gives me a lot of happiness, consuming, a piece of cake today or saving money for 30 years and eating a piece of cake 30 years from now. The point is that if I have to wait 30 years to get to eat the piece of cake, I don't. If I could eat that piece of cake today itself, and you want me to wait for 30 years in order to eat that piece of cake, you might better give me a lot more than just a piece of cake, because then why would I even want to wait for that long, right? So that's the kind of the opportunity cost of waiting to spend money, because delaying consumption is not um, is not free, right? As human beings, given that we have limited time period in which we are alive, we want as much consumption during the periods that we are alive, right? If we have to delay consumption further and further and further into the future, we need a significant compensation in order to do that. Okay, so that's the idea. With the interest rate, we are talking about there's multiple different arguments for why an interest rate should exist. One is that, of course, it should at least compensate for whatever is happening to the price level. So, what is happening to inflation? The other thing is that it needs to compensate for the level of default risk which is associated with it. And finally, it should compensate for the fact that I'm delaying consumption from one period to the next, and this time value of money argument needs to come through, right? So the reason why we care about the interest rate so much is because it provides a vital link from the present into the future, right? So if you think about any kind of financial transaction, these involve payments from in the future, right? So an asset that you buy today, you're not just going to buy it for you know for consuming it. It's not an asset if you just buy it and consume it in the same period. You buy an asset because you're anticipating that it'll throw off some cash flows into the future. And the importance of the interest rate is in the fact that it helps us translate how we take those cash flows from the future and then value them in the present time, right? So that's the crucial insight, that the interest rate provides a link between the financial present and the financial future and allows it to translate dollars which are received 10 years from now in terms of dollars today. Okay. All right. So, all right. So that takes us into these two twin ideas about thinking about compounding and discounting, right? So, what we refer to as the future value and the present value, right? So, the future value essentially tells us what a principal is the amount of investment that you have available, will grow to be in the future, as the name suggests. It's just asking the question: if I have $1,000 in my pocket today, and I is here as the interest rate that I can earn on this $1,000, what will it be worth in 1 year from now, or at any future period from now, right? So if it's just 1 year from now, it's it's just going to be the principal times 1 plus I, right? So you can see where it comes from. If I expand this out, it's just I get back the original principal, plus I get I% of the principal back as an interest payment. So I'm just, if I write them together, then I can just write it as the principal times 1 plus I, right? So if I take it to an n period model, so if instead of it just being for one period, I think about what is the future value of investment, which gives me I% per year for n years at a time. Then the future value at the end of n years, this needs to be the subscript. So the future value at the end of n years is going to be the principal times 1 plus I raised to n. Okay, so there is a good place to stop and think about where this formula comes from. So the formula comes from the fact that your interest is also getting compounded. So compounding is this phenomena where in the first period, you only have your principal. So you invest that money. At the end of the first year, you get back, you not only have invested your principal, but you also get an additional interest rate. So not only is your original principal getting invested now for the subsequent periods, but the interest that you earn at the end of the first period is also going to earn interest, right? So this is just a phenomena where the interest that you're accumulating, which you're accruing over um, uh, time, is also starting to earn interest, right? So compounding is that process of earning interest on interest as savings begin to accumulate over time, and the future value here after n periods is just going to be the principal that you started with times 1 plus I, where I is the interest rate that you're earning on a per year basis, raised to n here. N is the number of years that you have made the investment for. Okay. So here's a practical place where you can actually think about why you would care about this interest rate. So suppose you go to the bank and they're offering you two options, right? You go to the bank and you're thinking about investing $1,000 in one of the following bank CDs. So a CD is a certificate of deposit. So it has a stated interest rate and a maturity period. So it will tell you how much interest rate you'll earn and for how long you'll have to leave it in the bank for. Okay. So the first CD will pay an interest rate of 4% per year for 3 years. So it's a 3-year CD, and the annual interest rate on that is 4% per year. Okay. The second CD has a more uh, interesting structure, payout structure, where it'll pay an interest rate of 10% for the first year. So there's a big intro bonus, right? Relative to first CD, you would earn 10% rather than 4% in the first year. But then the interest rate drops to 1% in the second year and 1% in the third year. So both of them have the same maturity. You're going to lock up your $1,000 for 3 years. In the first case, you're going to earn 4% per year for 3 consecutive years. And in the second CD, there's a big sign up bonus where you get 10% for the first year, and then the interest rate drops to 1% in the second and the third year. And the question is, which CD should you choose? Okay. And then you just have to do a future value calculation. You want to know at the end of 3 years which investment opportunity will yield you the higher future value. So in the first one, it's fairly straightforward, right? The principal here is $1,000. I here the interest rate is 4%, and the number of years N here is 3 years. So the future value of this investment of this $1,000 at the end of 3 years, where it earns 4% per year, is the principal times 1 plus I. I here is 4%, so it's 0.04 raised to N, and here is 3 years, right? So that'll be worth $1,124.86 in 3 years if you put it in this CD, in the first CD. What about the second CD? How do I calculate the future value? Okay. In this case, it has different interest rates for different periods, right? So yeah, the principal is still the same. The principal is still $1,000, but I have I1, which is the interest rate I learn in the first period of 10%, I2, which is interest rate I learn in the second period of 1%, and I3, which is the interest rate I learn in 1% in the third year, and then the total time for which the maturity period of the CD is 3 years. So if I look at the future value calculation, I take my $1,000, right? So if I look at it logically, I take my $1,000, and first of all, I learn 10% on the $1,000 at the end of the first year. So this is what I will have in my account at the end of the first year. I'll have my $1,000 principal that I invested, so that stays in my account. Plus, I'd have earned an additional 10% on that. So I'd have $1,000 times 1 plus 0.1 at the end of the first year. Now this becomes the principal, right? This is the principal that I have, which becomes available for investment in the second period, and that gets invested at 1%. So this is how much I would have at the end of year two, right? This is the what I had at the end of year one. That grew at 1% rate, and that's what I would have at the end of year two. Okay. So whatever this is the principal that gets invested for year three. So at the end of year three, I would have this principal plus 1% of that principal together. I would have that is what I would end up with at the end of year three. And here you can see at the end of year three, I would end up with $1,122.11 if I went with the second CD. And here we have a future value where you can directly compare. So even though this is basically a warning to think about, even though this might be very attractive introductory interest rates on some financial products, you might want to do these future value calculations. Because if I just went into the bank and the bank said, oh yeah, we have like one which offers 4% for 3 years and the other one offers 10%, and that's where they leave it at, then you can straight away see that it might not it's not obvious that you always choose the one with the higher interest rate. You need to think about the maturity period, how long you have to wait, and if there is a different structure in the interest rates at different points in time. So based on this, obviously you choose the one with the higher future value, and in this case you might want to choose the first CD as the option to park your money. Okay. All right. So that's the first idea here, is this notion of compounding. So compounding again is that you start with some amount of principal, and that principal starts to accrue interest, and then not only does the principal keep accruing interest, but the interest that keeps getting paid out also starts earning interest, and that's the notion of compounding. And using that notion of compounding, we can think about this idea of a future value. So the companion idea here to this notion of compounding is this idea of discounting, right? So the intuitive explanation for why we call this discounting is that funds that become available in the future are invariably less valuable than what is available today, right? So in that sense, for us to make a fair valuation, what the basic idea here is very intuitive. $1,000 in my pocket today is worth more to me than the promise of $1,000 in 5 years. So these two things, even though at the end of it seems like I would end up with $1,000 in either case, the timing of when I receive that money actually matters, right? So $1,000 which I receive in the present period is worth more to me than $1,000 that I have to wait for a future period to receive. Right? So that's the idea, and that's the reason why we call this discounting, because if it's $1,000 in the future, it's going to be worth something less than $1,000 today, and how much less is the discount rate which is applied to that future payment, right? So the present value essentially tells us is the value today, right? The crucial idea is that we're valuing it in today. That's why it's the present value of funds that will be received in the future. How do we uh, how do we set an appropriate discount rate to value funds that become available in the future? And this is what we call the time value of money. It tells us that how the value of a payment changes based on when it gets made, right? Depending on when the timing of the payment is actually quite crucial to understanding what its value is today. Okay. All right. So with the companion pieces here, one idea is compounding. Compounding is starting from the present value and then looking at the interest rate that gets applied to it and for what duration, and that's what we arrive at as the future value. Discounting is basically the opposite. If I know the future value, so compounding is when I know the present value, this is known, interest rate is known, and the time to maturity is known, and then I can calculate the future value. Here I have the future value is known, so I know what payment I'll receive. I know what in how many years I have to wait to receive that payment, and I know what I will forego, what is the interest rate I have to forego in order to receive that payment in that period, and that tells me what the present value is. Okay, it's just the opposite of compounding. All right, so let's take a look at some key features, some important points that you need to remember about discounting, right? So all of that follows from this formula itself, right? So every single thing that I have to mention here follows from this idea. So the first thing is, of course, that sometimes you will see that a present value is also written as present discounted value. Don't get confused. It's the same thing. If you're more pedantic, you can call it a present discounted value, but generally speaking, we refer to it as the present value. The first thing to notice is that the further in the future a payment is to be received, the smaller its present value, right? That makes sense, right? So if n here is very large, so if I have to wait for a longer period of time for me to receive this payment, this future value payment, if n here is very large, 1 plus I raised to n is going to be a very big number. So the denominator is going to be very large. So if I'm dividing the same number by a very large denominator, the present value is going to be smaller. So it's just completely purely driven mechanically by the construction of the formula for the discounting, right? So if the longer I have to wait to receive this future value payment, the smaller its present value is going to be. The higher the interest rate that is used to discount these payments, the lower the present value is going to be. So if I here is very large and if FE is the same, so if I here is very large, then the denominator again is going to be quite large. And if the denominator is larger, then the present value is going to be smaller, right? So the higher the interest rate used to discount future payments, the smaller the present value of those payments. Okay? Now, the last point here is the most crucial point that I want to mention here, right? Because this is the genesis of how we do valuation or asset pricing in general. So the present value of a series of future payments is simply the sum of the discounted value of each individual payment, right? So when we think about a financial asset, when we think about asset pricing in general and the financial asset in particular, it's an asset which is going to throw off these cash flows at different points in time. So for me to figure out what is the fair value at which I should be willing to buy this asset today, I need to know the timing of the arrival of these cash flows and what is the appropriate interest rate that I use to discount these cash flows. And the sum of all of that tells me how much I should be willing to pay for that asset or for that series of those cash flows today. Right? So that's one crucial element of all of this compounding, discounting, and the present discounted value analysis, is that it gives us the first understanding, the first foray into understanding how do we value financial assets in general. Okay. And here's a table which basically captures all of these features together, right? So at an interest rate of 5%, if you look at this, right, each of this is the present value of $1,000 payment, right? So it's going to be $1,000 payment, and which is going to be received. So if I receive it in 1 year from now, where the interest rate that I forego on it is 1%, then it's worth $990.10. Said otherwise, what it means is that if I take $990.10, stick it in a bank which pays me a 1% interest rate, then I would receive $1,000 payment 1 year from now, right? It would be worth $1,000 1 year from now. So instead, if the bank paid me 2%, I would have to only put away $980.39, and I would have $1,000 1 year from now. So the higher the interest rate is going to be, the lower the present value would be, right? So in a intuitive way, if the interest rate, if the bank is willing to pay me 20% of interest per year, then I don't need to put away a lot of money in order to receive this $1,000 payment 1 year from now. I need to just put away $833 when the interest rate is 20% relative to putting away $990.10 when the interest rate is 1%. So the higher the interest rate is, the lower the present value of a future payment. Okay. That's the first dimension, is to see that as interest rates go up, the present value is going to go down. Okay. The other dimension is obviously on the time dimension. So the longer, given the same, it's holding the interest rate fixed, the longer I have to wait for this payment, the lower that value is going to be. So if this $1,000 payment is going to come 1 year from now, then it's worth $990.10 to me today. But if the same $1,000 payment is going to be made 5 years from now, it's only worth $951.47 to me today. And if it's going to be paid 30 years from now, it's only worth $741.92 to me today, right? So given, if I fix the interest rate based on the time to maturity, the present value of those investments also comes down. Okay, so that's the two dimensions, and you can always reason it out just by looking at this formula of the present value, right? So if I is large, given n is fixed, then present value falls. If I is fixed, then n is large. If n is increased, then present value falls. And if the future value goes up, where I and n are fixed, then the present value also goes up. Okay, so that's just mechanically from the formula for the thing, right? So here's a example, a real world example where you can actually see how this works out. Right? So the following data that we have here is that we are talking about how much additional earnings do college graduates have over high school graduates by age, right? So at age 22, college graduates on average are making $7,200 more than people with only a high school degree. By age 23, again, the difference is 7,200, and 24 is 7,300, and 25, 7,300. Okay. So the question then becomes, what is the present value of a college education from ages 22 to 25, assuming that the interest rate is 5%, right? Suppose the interest rate is 5%, what is the present value of a college degree, right? So if I have a college degree, how much more money would I make relative to just going to work with a high school degree? If I have a college degree, then I have an additional $7,200 in the first period at age 22. Then $1,200 in the second period, which is at age 23. This is the additional amount which I would receive at age 23. This is the additional amount I would receive at age 24. So that's 3 years from now. And then this is the amount I would receive, 7,300 additional dollars that I'd receive by uh, year 4, which is at age 25, right? So the thing here to recognize is that this is a decision. I'm making the present value calculation before I'm deciding whether I should go to college or not. So if I go to college in the following year, I would have $7,200. So that's why this is raised to 1. This is $7,000, $2,000 that I receive one period from now. Okay. This is 7,200 additional dollars that I receive 2 periods from now. That's why it's getting discounted by 2 periods here. There's a 7,300 additional dollars that I receive 3 periods from now, and there's 7,300 additional dollars that I receive 4 periods from now. So the present value of going to college then over high school degree is about $26,000. Right? So based on this, and that you've calculated this present value of you calculated the present value of a college degree, what decision should you make? Okay. Okay. So based on this, if your college degree is going to cost anything less than $26,000 over the next 4 years, it makes absolute sense for you to go ahead and think about going to college, because you will end up with at least 26,000 additional dollars on average, the average college graduate in just those 4 year periods, and that trend continues to hold till your normal retirement age. So if you continue this calculation and see what the differential is, the differential starts to get wider and wider, right? So what we find is that people with college degrees, that gap never narrows. The people with just a high school degree never manage to narrow that gap. If anything, that gap starts to get wider and wider as people gain more and more experience in the workforce. And if you do this calculation up to retirement age, that tells you what the fair value of a college degree should be, right? So as long as this price of receiving that college degree is lower than what you would have earned in additional earnings over your lifetime, it makes sense for you to consider going to college. And of course, it's not just about the benefits. You need to compare it against the cost. So going to college is not free. There's some explicit and implicit costs with associated with going to college. Of course, you need to pay tuition, you need to pay for books, you need to consider the opportunity cost of attending college, and what else you could be doing with your time relative to attending college, and the income of the specific occupation, right? How wide is the differential for the college degree that you received relative to high school education? So some degrees, obviously, the differential is going to be higher, something like engineering, something more in the hard sciences, the differential is going to be higher versus something like an English lit major, right? Or something in the liberal arts, right? So the point of this exercise is that when there are payments which come in the future, we need a mechanism to think about how to value them in the current period, because you're going to spend your money or make a decision in the current period. So everything needs to be expressed in current period dollars for it to make a like for like comparison, right? The decision to go to college, you're going to pay the tuition today. So you need to know how much additional earnings you're going to receive from the college degree in over your lifetime for you to understand if it is worth it for you to go to college or not. And more or less, if you do this calculation, it's always going to turn out that it's worth it to go to college, as long as it's differential between high school and college degrees, sufficiently large enough. All right. All right. So that's the crucial thing about discounting, is that it lets us compare the prices of financial assets, because now I can, if I know the present value of these different cash flows, right? If I think about these as different payments which are coming through at different points in time, this is basically kind of a financial asset. So if I think of this college degree as a financial asset, which is to say it throws off additional cash flows at different periods of time from having this piece of paper that I call a college degree, then you can basically think of it as a financial asset, right? So that piece of paper with your name on it, it says what degree you received, is entitling you to these additional cash payments at different points in time. So straight away you can start to put a price on these things, and that's the crucial thing with discounting, is that because tells us what the value, it tells us how to value these different cash flows that a financial asset throws off. Now we can begin to use that as a proxy for the price and begin to compare among different financial assets, right? So the price of an asset is determined by adding up the present value of all the payments from its sellers to its buyers, right? So when we buy an asset, we are buying it in the anticipation that it throws off these cash flows into the future. And if we are able to find the discounted value of each of these cash flows that go into the future and add them all up, which is the present value calculation that we've been doing, that tells us the price of the asset. And now once we can do that for different kinds of financial asset, now we can begin to compare among different financial assets and choose which one is better, right? Do I go into a CD which pays 10% for the first year and 1% for the following 2 years, or do I stay in a CD which pays 4% for 3 years? Now I can put a price on those things, and then I can see, I can begin to compare. This discounting and compounding allows us to put prices to financial assets, and now we can compare between these different kinds of assets. All right. All right. So now that we have a basic framework in mind as to how to understand interest rates, how to calculate present values and future values, we'll go on and talk about bonds and debt instruments, right? So how do we distinguish between different kinds of debt instruments, and then also consider how the prices of these debt instruments are determined. Yeah. So let's get started. So with the debt instrument in general, what we are what we are trying to um, uh, okay, let me just start over. So when we think about the price of a financial asset, what we've talked about is that, okay, a financial asset throws off these different cash flows at different points in time. If we're able to figure out the discounted value of each of those cash flows and add them all up, which is what we do in a present value calculation, that tells us the price of that asset. Hmm? With the debt instrument, that's basically what the situation is, right? So with the debt instrument, we'll talk about different kinds of debt instruments like simple loans, discount bonds, coupon bonds, and fixed payment bonds. But what we have is that it's a financial instrument where you borrow money at one period in time in order to finance some large purchase or transaction, and then you make periodic payments over and over again over the lifetime. Right? So uh, when we talk about debt instruments, we can talk about four different kinds of debt instruments: simple loans, discount bonds, coupon bonds, and fixed payment loans, and see how the price, what is the differences between each of these bonds, and how the price of the bond itself is determined. Okay? A simple loan is very straightforward, right? A simple loan is where the borrower receives some amount of money, which is called a principal, and agrees to pay the lender the principal plus interest over that on a specific date. Okay. So if you go to, this is what we generally consider to, when we say loan, this is what we generally have in mind, right? So Nate receives $10,000 loan from Bank of America today. 1 year from now, he pays back Bank of America $11,000. So after 1 year, the principal that was borrowed is repaid, and and an interest which was charged on that principal of about 10% was also repaid, and so a total of $11,000 is repaid at the end of year one. This is a very simple debt instrument. This is a simple loan. There's not much to it. A discount bond, on the other hand, is a very interesting idea. A discount bond is where the borrower receives, uh, less than the principal that they're borrowing in the first period, right? This is essentially a way of saying the borrower basically prepays the interest on this bond. Okay, so what does it mean? So if I think about this discount bond, the borrower in this case is set to borrow $10,000 in principal, right? So the borrower has to repay $10,000 in principal, but he receives only $9,000.91 from the discount bond, which is to say, even the rest of it, the difference between the $10,000 that the borrower repays and the $9,000.91 that the borrower receives in the bank, that difference is basically the interest rate for interest payment for the year. The $909, which is about, if you take the percentages here, 909 over 9,091 is about a 10% interest rate. Okay, so a discount bond is where a principal is agreed upon that I agree to pay you back $10,000, but it's not that I borrow some principal and then pay you back the principal plus interest at the end of the maturity. Essentially, borrow money from you and you deduct the interest that I owe you right at the source, right when I borrow the money, and deposit the rest in my bank account. This is like a safer transaction, right? You don't, you already are getting your interest payment ahead of time, so at least the cost of servicing the loan is covered, and the principal comes back to you in a year's time, right? A coupon bond in general is a debt instrument that requires that there's multiple payments of interest on a regular basis, and then at the end of the period there is the uh, payment of the face value at maturity, right? So the name comes from the fact that it really used to be a physical bond like this piece of paper here, where on the top of the top half of the paper, the face value of the bond is printed, and it would have all these coupons for interest payments. So what you would do is that you would clip the coupon. So each month, if you're entitled to an interest payment, what you would do is that cut out this coupon from that bond, you cut it out, and then you mail it in, right? So if governments have issued coupon bonds, corporations issue coupon bonds to raise corporate debt, whatever it is, you just cut out the coupon and send it in to the corporation or the government which borrowed money from you, and in return they make the interest payment in the form of check. So once you collect all these coupon payments, in the last period you go back to them, and then you send in the last piece of paper, which is where the face value of the coupon bond is printed, and then you receive a lump sum payment. The payment of the face value gets made at maturity, right? So there's a few things about the terminology around this coupon bond. The first thing is the face value, right? The face value is like acts as the principal. That is what needs to be repaid by the bond issuer at maturity, right? What is printed on the top half here. Then there is a coupon, which tells us on an annualized level what is the fixed dollar amount of interest that is paid by the issuer of the bond, right? So everything here, whatever written as C's are basically your coupons. So you cut out a coupon. The coupon says that it lists a dollar amount. So you mail in the coupon for that, and then you receive that in the form of a check, right? That basically acts as your interest payment. So all your coupons that you collect over the lifetime of the bond are the interest payments that you're entitled to. And at the end of the maturity of that bond structure, you receive back the original principal, which is the face value, which is less from the bond. Okay. So a couple of things to keep in mind. The coupon rate tells me, what the value of the coupon is expressed as a percentage of the face value. The face value is also called the par value. Par value, face value, they're the same thing. So the coupon rate is basically the coupon payment, whatever is the amount here, over the face value times 100%. And the current yield tells us what is the value of the coupon expressed as a percentage of the current price. So it tells us if this bond is trading inside a bond market, then the price of this bond is going to keep changing. So the current yield tells me, given that this is the coupon payment that the bondholder is entitled to, and this is the current price that the bond is trading at, the ratio of those two is what we call the current yield. Okay. So we'll talk about all of these in a little bit more detail. Okay. All right. So who issues coupon bonds? Basically, the US Treasury, the state and local governments, large corporations all issue coupon bonds. And typically speaking, the face value of a typical coupon bond is standardized as $1,000. Right? You might see other denominations, but generally speaking, all coupon bonds or most coupon bonds have a face value of $1,000. And then there is if the bond has an annual coupon of $50 and a face value of $1,000, then its coupon rate is just the coupon amount over the face value or the par value. So that's 50 over 1,000 or 5%. So this is a bond which has a coupon rate of 5%. And the price of the bond may differ, right? When we talk about the current yield, the price of the bond, once it's allowed to trade as part of the market, the price of the bond might fluctuate. So we'll get into what happens when the price of the bond fluctuates in just a second. But it makes sense that, if Apple issues some corporate debt, and initially people bought all these corporate bonds that Apple issued, then they don't want to hold on to these bonds anymore. So they go into a financial market, into the bond market, and want to sell it and receive cash for it. So as they're selling it, based on what has happened from the time they bought the bond and what the current situation of Apple is, the price of that bond might go up, come down based on if there is a lot of demand or if there's too much supply of that bond in the market. So the price of the bond itself, once it begins to trade as part of the secondary markets, will fluctuate, which is to say the current yield of the bond will fluctuate. But the coupon rate is now going to fluctuate. The coupon rate is going to be fixed, but the current yield on the bond, which tells us the ratio between the value of the coupon over the price, over the current price, will fluctuate because the current price is going to go up and down. Okay. So with the coupon bond, the other thing to take into account is the maturity. Is the length of time before the bond expires and repays back the par value, the face value of the bond is repaid, right? So for instance, suppose IBM issues $1,000 30-year bond, right? $1,000 is the face value, 30-year is the maturity, time to maturity of the bond, with a coupon rate of 10%, right? So basically what you would have here is a structure like this, right? So, I mean, in the olden times when these used to be paper instruments and rather than digital things, so here you would have $1,000. This is the last payment, and then you would have these multiple coupons, right? You would have 30 coupons because it's a 30-year bond, so you need to issue 30 coupons, and each year the coupon would print out $100, right? So you get $100 each year, and this is what the structure would look like, right? So today, when you buy that bond, right, from IBM receives that $1,000 from the coupon bond it issues, and then over the next 30 years, till year 29, all it does is makes a coupon payment, right? $100 in year one, $100 in year two, $100 in year three. So it's making just interest payments every single year until year 29, and in the last year, it not only makes its final interest payment but also repays the principal that's issued, and this is what we'll call a coupon bond. Okay. All right. And we'll get into how to value this in just a second, but I just want to introduce one other kind of debt instrument before we go into talking about valuation and bond prices and yield to maturity and everything else that goes along with it. Okay. So the last kind of debt instrument that I want to talk about is what we call a fixed payment loan. So you receive $1,000 loan, and then instead of this principal being repaid as a balloon payment at the end of it or whatever, this is what we also call an amortized loan. So every period, the payment that you have is fixed. Some portion of this payment that you're making goes towards repaying the interest that is owed on the borrowing, and the rest is used to apply to writing down the principal, right? So you're repaying, suppose you take a $10,000 loan, this is a 10-year student loan with a 9% interest rate, so your monthly payment is approximately $127. So this is at least this is a more preferred way of for both borrowers and lenders, because it manages risk in a much more reasonable way, right? So if I take a look at something like a coupon bond, At the end of the period is when all of the principal needs to get returned all at the same time. So if there is something happens in this period, then you might really be in trouble, because all you've received so far is just interest payments on that. But the principal, the big lump sum which was lent out, is going to only arrive in the last period. Right? It's the same case with a discount bond, with a simple loan as well. Right? The principal gets repaid only at the end of the maturity period. So what this kind of fixed payment loan does is that it avoids this problem. It amortizes. So every period when you send me a payment, you're not only paying me the interest which is owed for that period. So on 9% of interest rate that is owed for that period, but also the rest of that payment. So you make additional payment, which basically goes towards writing down the principal. So you're not only servicing the interest portion of the debt, you're also writing down the principal at the same time. So if you keep this up at the end of the maturity period, both the interest payments, all the required interest payments are made, and so is the principal, right? So there's no balloon payment at the end, and it's a much more a much easier way of managing uh, you know managing the risk, right? Because there's no balloon payment, so people don't just make the interest payments, and when it comes time to make the principal payment, they just don't default on it, right? You can guard against that with this kind of a structure. Okay, so with debt structures, we'll spend a lot of time talking about coupon bonds in this particular course, because this is the most dominant way in which US government debt in general for most countries, and corporate debt is issued, right? So you might have other loan structures which are a little bit more, this fixed payment loan structure is much more dominant in like the mortgage industry, right? Where you get, a normal run of the mill vanilla type mortgage. This is what you would have. You would have a fixed payment every single month for 30 years. And at the end of the 30 years, the principal is repaid and the interest is repaid, and you own the house free and clear, right? So as opposed to, like, let's say you just make interest payments for 30 years, and at the end of year 30, you have to return the principal of, I don't know, $1 million or something. That would be much more difficult to do, rather than this kind of amortized loan structure. Okay, so which takes us into understanding, okay, how do we measure, right? How do we find the bond? How do we determine the price of a bond? And what is the relationship between the price of the bond and the yield to maturity? Okay, so here's a easy example to get the ball rolling, right? Suppose we start with a coupon bond, right? This is a coupon bond where the interest rate is 6%, right? The interest rate and the coupon rate are terms which are used interchangeably. So if I say interest rate on the bond or coupon rate on the bond, I mean the same thing, okay? So this has an interest rate or a coupon rate of 6%. The face value of the bond is $1,000, and the time to maturity of this bond is 5 years, okay? So if I think about the structure of this bond throws out 6 different payments. It throws out a $60 payment. So because it's 6% of $1,000, which is $60, that's the interest payment. So it sends out a coupon payment in year 1, sends out a coupon payment in year 2, sends out a coupon payment in year 3, year 4, year 5, right? In year 5, there is an additional payment because it's a 5-year bond. In the year 5, it also repays the face value of the bond, and then the bond is, all the payments have been made, and that's all. Okay. So I know now that, okay, the $60 payment that I receive 1 year. So standing here today, I want to know what the price of this bond should be. So I know that this first $60 payment is going to come 1 year from now. So I discount it by 1 over 1 plus I. Then the second coupon payment comes 2 years from now. So that's discounted by 1 plus I squared. The third coupon payment comes 3 years from now. So that's discounted by 1 plus I cube. The fourth payment is coming 4 years from now. So that's 1 plus I raised to 4. And then the fifth coupon payment and the face value both come in year 5. So that they're both discounted by 1 plus I raised to 5. Okay. So if I have to find if I know I, the question is what should I be? But if I know I, okay, then I can determine what the fair price of this bond should be. Okay. So for a bond that makes coupon payments, the same coupon payment and matures in N years, then the present value of that bond, of those coupon payments, and the face value that pays off, which is what we call the price of this bond, is determined by this simple formula here, right? So each coupon payment is discounted by how many years I have to wait for it. So I get that. And then the last face value is discounted by the length of the maturity. So 1 plus I raised to the maturity time for the bond itself. Okay. Now, one thing for you to verify, right? If I plug in the 6% here, right? If I here is going to just be 6%, then this price of this bond is just going to be $1,000. I just want you to verify that. I'll show you why that should be the case in just a second, but that's one thing to keep in mind. Okay. All right. Now, the yield to maturity, right? So the yield to maturity is a way of saying, if this bond has if I buy this bond for a particular price, right? And given that I am entitled to all the payments that asset makes from the time I purchase the asset to its maturity period, right? So a yield to maturity is a way of saying, suppose Apple issues a bond, right? Someone bought that bond, they received a few coupon payments from it, and then they decide, okay, I don't want to hold on to Apple debt anymore and I want to sell it off, and you're interested in buying Apple debt. So if you buy that Apple bond from this person, you're entitled to all the coupon payments that Apple makes from that period on, going until the bond matures, until the bond finishes paying off, and then you earn some yield on it. And the yield that you earn, the return that you will earn on that investment, depends on the price that you paid for that bond, right? So for instance, if I think about a simple loan, for a $10,000 loan that is required to pay $11,000 in 1 year, I can determine what the interest rate is, what the yield to maturity is, right? So I will receive $10,000 here, right? So the value today is $10,000. The present value from the future payments is going to be the $10,000 in principal that I get back, plus $1,000 in interest payment. So if I solve for I here, so that comes back 1 year from now. So this is the present value of future payments, right? So this is the present value of future payments. This is the price I pay for it today, the value of it today. So if I solve for I here, then I get that I should be 10%, which makes sense, right? That's what it is. For a discount bond, it's a similar story, right? Consider a 10,000 year, 1 year discount bond with a value of $9,200 today, right? So what is the yield on this bond? So the value of this bond today is the present value of future payments, right? You equate those two things today. So the value of the bond today is $9,200. That's what I receive in the bank account today. In return, I need to make a payment of $10,000 in the future 1 year from now. So this is the present value of future payments. So that, and then if I solve for I here, right? So that's 10,000 minus 9,200 or 9,200. That turns out is about 8.7%, right? So 1 year discount bonds that sells for a price P with a face value of FE, the yield to maturity I here is given by FE minus P over P. Right? You don't need this formula. You can just generally, like if you set it up correctly, then it all makes sense, right? So yield to maturity is this idea is to say, suppose this is the value of an object today, and this is how much I need to pay for that object. What is the yield which makes those two things the same? What makes the value today of that object equal to the present value of the future payments I need to make in order to own that object today, right? So that, if once you set that up, the interest rate that equals these two things is what we call the yield to maturity. Okay. So for a fixed payment loan, again, similar story. For $100,000 loan with annual payments of $12,731, the value today of this is that I own an asset which is worth $100,000. So that's the value of the loan today. Should be equal to the present value of future payments. So this is, I set it up. So I make a payment of $12,731 for 20 years, and if I essentially calculate I here, that tells me what the yield to maturity on this loan is. Okay. So for a fixed payment loan, this is how I set it up. The loan value should be equal to the future payments. And then if I solve for I, then that tells me what that future payment should be. or the other way, if I know what I want to charge, then I can also back out what the future payment should be, what each of these future payments should be equal to future payments should be. And that's how they calculate it, right? Like if you go into your bank and want a mortgage, or you go into uh, car showroom and then you want to buy a car, this is basically the formula into which they're punching everything in, right? So if they want to charge you a 5% interest rate, just put 5 in the denominator. Wherever you see I, that's a 5%. And it's a 10-year loan, then you know what n here is 10, and you know the value of the car. So if the car is worth 40 grand, so you put 40 grand, and that tells you what the payment should be each month, right? That's how they're coming up with that number. Okay. One key thing that I want to mention here is this thing called a perpetuity. A perpetuity used to be, is still kind of used quite often. A perpetuity is a debt instrument which just makes payments, and there is no fixed maturity period to it, right? So perpetuity does not ever mature, which is to say it just keeps paying this coupon bond, right? And it pays an infinite number of coupons. So as long as that company is in business, and as long as you are alive, or some bondholder is alive somewhere, it just keeps throwing up these coupon payments every single time. And the formula for understanding the price of a perpetuity, this comes from essentially simplifying the geometric progression formula. Is just C over I, right? Where C is the coupon payment and I here is the interest rate. Okay? So if so, perpetuity which has a coupon of $25, so C here is $25, and the price of $500 will have a yield to maturity of about 5%, right? So P here is 525. So if I plug in 500 here, and then this is 25, so that's 25 over 500, which is 0.05 or 5%. Okay. All right. So here's an example where I just want you to work out for yourself. I mean, I'll show you the results to this. I'll show you the how to work these things out in the next slides. But you can pause it right here and just work it out for yourself for a few minutes. And once you've worked out the 4 questions, then you can just unpause and then watch what happens. Like you can watch the solutions here. Okay, just to make sure that you understand what's going on. So we want to calculate the yields to maturity for these 4 kinds of different bonds, different kind of debt instruments. The first one is a simple loan for $500,000 that requires a payment of $700,000 in 4 years. Okay, so how do I set it up? It's straightforward. The value today here is $500,000 should be equal to the present value of these future payments. So I make a payment of $700,000. That's the future value, but this comes in 4 years. 1 plus I raised to 4. So this is the discounted value of $700,000 that needs to get repaid in 4 years' time, and the value of that loan today is $500,000. So if I can set it up and solve for I, right? So essentially it's 7 over 5, the 4th root of 7 over 5 minus 1. Okay. So I'm just setting it up so you don't like you can go ahead and solve it. Okay. So write an equation for yield to maturity for a debt instrument in B. So what is B here? It's a discount bond with a price today of 9,000. So today's value is 9,000, face value of $10,000, and matures in 1 year. Right. So how do I set it up? Value today $9,000 should be equal to the present value of this future payment. So there's only one future payment of $10,000, which comes 1 year from now. So I can solve for I that. Okay. What about the third case? It's a corporate bond with a face value of $1,000, price of 975, coupon rate of 10%, maturity of 5 years. It's slightly more complicated, but not that much. The price is the value today, so that's 975. That much is clear. The next part of it is that it is for 5 years and the coupon rate is 10%, which means that it has to make 5 coupon payments, one for each year. So if it's a 10% of $1,000, that's $100 coupon payment in year 1, year 2, year 3, year 4, year 5. Right, the 5 coupon payments that it needs to make, and in the last period, it not only returns the coupon payment but also returns the face value of that bond of $1,000, but that's discounted by 1 plus I raised to 5. Okay. All right. And finally, for the last one, a student loan of $2,500, which requires payments of $315 per year for 25 years. Okay. And the payment starts in 2 years. Okay. So it's like a payment which is deferred, where you don't make any payments while you're still in school. But once you graduate, you start making those payments, and it's an equal payment. It's a fixed payment loan of $315 per year for the next 25 years. And the loan amount is $2,500. Okay. So the loan amount today is worth $2,500. The first payment, however, starts 2 years from now. That's a crucial thing, that this $315 that I need to pay, I don't pay it this year or the next year. It's 2 years from now, so it's discounted by 1 plus I squared, and then it keeps going till I hit 1 plus I raised to 26, because it is a 25-year loan, so I need to make 25 payments. So if this starts at 2, it needs to end at 26, right? Because if it starts at 1, then it'll end at 25. That's a 25-year loan, and this is a 25-year loan where the payment starts 2 years from now. Okay, so if you can solve for I in this case, right, then you basically have the yield to maturity on that instrument. Right? So generally speaking, for any of these cases where this slightly more complicated, like other than for the case where it's a discount bond or like a simple loan or something like that, it's not that feasible to just calculate it by hand. So generally you punch it into a financial calculator. So if you have a financial calculator, you can just punch in these numbers and I will just pop up. So there's a yield to maturity calculation. So uh, if you have a financial calculator, just punch it in there, or you can always do this in Excel. Excel also has a nice function which will calculate the yield to maturity. So it'll take as inputs the present value, the coupon payments, or if it's a coupon payments, the face value and the duration as the arguments of that function, and then it'll spit out the yield to maturity as well. Okay. So in a practical sense, how do I calculate I? This is like, it's a fifth order polynomial. It's just very difficult to calculate this just by hand. So we generally end up using some kind of a calculator or a Excel spreadsheet to do this. Same thing here. Okay. All right. So that's the third key idea that I want you to take away so far, right? So we started with this discussion with what interest rates are, why we need interest rates, what they're compensating for. Then we started talking about debt instruments. These are the instruments which rely so heavily on interest rates. We talked about different kinds of debt instruments. We talked about simple loans, fixed payment loans, coupon bonds, discount bonds, and what the structure of these bonds look like. Then straight away, considering that we know these ideas of compounding and discounting, we have this framework on which we can begin to consider the price of these bonds. And finally, when we have this notion of yield to maturity, where we want to know what is the interest rate, what is the I, which makes the value of that financial asset today equal to the present value of the future payments that that asset throws out, right? What is the implied yield to maturity from buying the asset which is valued at this much today and holding it until maturity from that period? Okay. All right. So, which takes us into a very crucial idea in bond pricing in general, this inverse relationship between bond prices and bond yields, right? So, to understand this, we can start with a very simple thought experiment. Right? All right. So here's the thought experiment. So suppose you okay. So you go out and the U.S. government has been issuing bonds forever, right? So suppose you bought a bond where the US government, it was a 10-year or a 30-year bond from the US government, and the coupon rate on that bond was, I don't know, let's say 10%, just for the sake of argument, let's say it's 10%. Okay, so far so good, nothing has really changed. And then the US government comes up with a new debt issue, so they want to borrow some more money, and they issue a new bond where they promise a coupon payment is 12%. Intuitively, what has happened? Now there is a new bond on the market issued by exactly the same entity as you bought your bond from for exactly the same maturity period, right? Of 30-year maturity period at a higher interest rate. Now the old bonds that you bought are not as valuable, right? Which means that as the interest rate goes up, the price of that bond, once the bond yield is higher, the bond's market price will fall below its face value, right? Because it makes sense, because instead of it paying, instead of you owning a bond which pays 10%, now there is a new bond in town which pays 12% issued by the same entity for the same maturity period. So everyone wants to buy the bond with a higher coupon rate, which means that there is a decrease in demand for the older bonds, which is to say the price as the bond yield is higher, the bond's market price will fall below its face value. So when interest rates rise, what happens is that bond prices fall in order to compensate for that. And this is a crucial relationship to bear in mind, right? That there's this inverse relationship between how asset prices move relative to moves in the interest rate, right? So capital gain occurs when the market price of an asset increases. When we talked about capital gains and capital losses. So if I bought an asset for $10 and then it becomes worth $12, then I will realize the capital gain because the price of the asset has gone up. And if I buy that asset for $10 and goes down to $8, then I've realized the capital loss because the market price of that asset has declined. Okay, so just to motivate why this matters, right? So during the financial crisis of 2007 to 2008, banks began to reduce the amount of lending that they did, right? Because they were already in a great deal of financial distress. They didn't want to continue to lend into that market, and they started to curtail how much lending they did. Okay. So in the mortgage-backed securities market, we talked about this, where borrowers began to default on their payment. So buyers required much higher yields to compensate for more default risk, right? Which is to say, as more and more borrowers were underwater on their mortgages, they stopped making these payments. These bonds became very risky. In order to be, we already discussed it, that one reason, one crucial element which determines how high the interest rate on a bond is is the probability of default. What is the level of default risk associated with it? As the default risk climbs, the interest rate on these bonds also goes up, right? So as the interest rate which is required on these bonds goes up, what happens to the price of these bonds, right? The price of many mortgage-backed securities began to decline and decline by 50% or more, right? So here's the situation that you are faced with. You bought into a mortgage-backed security portfolio in 2005 with where the average yield on those bonds was about, let's say, 10%. Suddenly there's all these mortgages which are going under, and people are demanding higher and higher rates in order to compensate in order to compensate for the fact that the default risk is much higher. Now suppose the maturity, suppose the yield on those bonds is gone up to 15% for the same maturity period. So that means that the price of the original mortgage-backed securities that you bought back in 2005 are now worth much less, because they are only yielding 10% rather than the 12% that the new bonds are yielding. And so the price of these bonds, as we discussed, that when interest rates rise, these bond prices need to fall, and the prices of these bonds began to fall. So if the price of these bonds began to fall, that you start to have massive losses on your balance sheet, because the assets that you bought at a particular price are now all losing their value significantly, like 50% or more in some cases. And over $1 trillion of these investments, the value was wiped out, right? During the just the initial uh, period of the crisis itself, right? So that's the crucial thing. So yields to maturity and bond prices move in opposite directions, right? If interest rates on newly issued bonds rise, then the price of existing bonds needs to fall, and vice versa, right? So if you own a bond which was paying from Apple, or a US government bond, let's say it's a US government bond, 10-year bond with a yield of 10%, and now the US government issues a new 10-year bond a couple of years later, and now they are only paying 8%. Now the bond that you own, which has a guaranteed payment of 10%, is much more valuable than the newly issued bond. So there is a higher demand for your bond, which yields 10%, which is to say the price of that bond goes up. So if the interest rate goes up on a bond, right? If the interest rate on newly issued bonds rises, then the price of existing bonds falls, right? That's the crucial thing. It's newly issued bonds interest rate goes up, price of existing already issued bonds goes down. Okay, and if the newly issued bonds are issued at a lower interest rate, then the price of existing bonds, which were original bonds or older bonds which were issued at a higher interest rate, now go up, right? So that's the crucial element, right? Is basic supply and demand, which determines this kind of mechanical relationship between yields to maturity or interest rates and bond prices. And this should hold for any other kind of debt instrument which operates in this way. Okay. So one thing to keep in mind is that once we allow these bond instruments to begin to trade on the secondary market, so a trader is essentially trying to buy and sell these securities in the secondary market to leverage changes in prices, right? So there is the age-old um, debate between what is the difference between trading and investing. Investing is about trying to find value. Trading is about trying to exploit price changes, right? So when a bond is issued and then the interest rate, so a new bond is issued at a higher interest rate, let's say, so the price of existing bonds needs to fall, right? They don't fall immediately. There is a lag between when that information hits the market and for the market to react and to price on this change. So there is a lag and there is an opportunity for an arbitrage, right? The financial arbitrage is basically a way of saying buying and selling securities to profit from price changes over a small period of time, right? So sometimes in these markets, when markets are not completely efficient, then you might open up small arbitrage opportunities which you can leverage. Because when the new bond is issued at a higher interest rate, we know immediately that the price of existing bonds needs to fall, and we know how much it needs to fall by, but it just takes a brief amount of time for it to fall, right? There is a lag in there. And if that lag is sufficiently long enough, or you are sufficiently efficient enough at exploiting that gap, now you have a financial arbitrage opportunity where you can sell that bond before its price falls and buy it back, right? You can go short on it. So uh, the, the price of financial securities at any given moment, especially in well-developed efficient markets, don't really allow for too much financial arbitrage. Very rarely are going to find that this kind of arbitrage opportunities, but it's one thing to keep in mind when you're working with bonds in general, when you're working with fixed income securities and bond pricing in general. As one thing to keep in mind is that when there is interest rate fluctuations, there needs to be commensurate price fluctuations. And if the interest rate fluctuation is not reflected one to one in the price reaction, then there might be an arbitrage opportunity which might open up for a brief window, which can be exploited. Okay, so law of one price says that that identical products should sell for the same prices everywhere. That's the kind of it's the bedrock principle around which trade theory is built. But financial arbitrage disappears when the law of one price again becomes true, right? When other people recognize that there's a financial arbitrage opportunity, then start flooding into the market, the price will begin to converge to its fundamental value, and that the arbitrage opportunity closes off, and then you can't really exploit it that much. Okay, I just want to briefly bring it up just to show you that like when what are bond traders trying to do on a day-to-day basis. One portion of it is to exploit any perceived arbitrage opportunities as and when they present themselves, okay, in the financial market. All right, so the couple of quick things that I want to mention here is, one thing is that, okay, we throw these terms around a little bit haphazardly. There's the coupon rate, there's an interest rate, right? The coupon rate and the interest rate on a bond are generally the same thing. There's a yield to maturity. The yield to maturity and the coupon rate and the interest rate are not all the same things, because the yield to maturity tells me that if I buy an asset for a particular price today, what is the yield what is the interest rate which will make the price at which I bought, the value of the asset today equal to the present value of the cash flows that that asset generates, right? That's the yield that will generate that. Okay. And now we'll talk about this notion of rate of return, right? A return is a security's total earnings, right? For a bond, you can think of the bond which is trading on the secondary market. You could get returns in two ways, right? First, the bond is going to make a coupon payment. You will collect that coupon payment for sure. So that's one way you make a return. The second way you can make a return from that bond is that from the price of that bond changing, right? So the rate of the return of a bond equals the coupon payment plus change in the price divided by the initial price that you paid for it. Okay. So for instance, a bond with $1,000 face value and a coupon rate of 5%, right? If at the end of the year, the price of this bond is $1,169.84, then what is the rate of return, right? So the rate of return for this bond is going to come from two sources. One is that you're going to get a coupon payment, which is 5% of $1,000, $50 is the coupon payment. That's one source of return from this instrument. The other source of return is from capital gains, right? This $1,000 bond is now worth $1,169.84. So you realize a capital gain of $169.84 over the original purchase price of $1,000. So you earned a return of 22%. So if you disaggregate it, what do you have? 5% of that return is from just a coupon from the interest rate, and 17% of this 22% return that you've gotten is coming from price appreciation, from capital gains. So once the price of the bond is allowed to fluctuate, you're not only going to be exposed to just the interest payments that you're going to get, but you're also going to be exposed to this capital gains and losses, right? So by the same token, if the year-end price is $864.09, then the rate of return is that here you have a capital loss. On a $1,000 bond that you paid $1,000 for, you earned a $50 coupon payment. The interest payment came through, no problem. But the value of the bond loss went down by $135.91. So now the total return on this bond is negative 8.6%. Right. So some of the decline in this bond's capital in the price is offset by the fact that you received a coupon payment, but it's still negative 8.6%. And the question as to why this end of the year, why is the price going up or going down, you already know what the explanation is. If the price has gone up here, right, if the price of this bond has gone up here, that suggests either there's an increase in demand for this bond relative to the available supply of this bond, or that there was a new bond issue, a new bond was issued which had a lower yield than these existing bonds, which made the price of the bond go up. Similarly, the price of the bond coming down suggests that there might have been a new bond issue where the interest rates on these newly issued bonds was higher, which means that the demand for older bonds went down and the price of the older bond also went down. Okay. So with the rate of return, the point I want you to understand is the fact that there's two sources in which you can earn a return from a bond. One is from the coupon payment that the bond makes, and the other is from the capital gains or losses that you can realize from the fact that the price of the bond fluctuates. Okay. So we can usually disaggregate the return on the bond into two sources of return. What we call the current yield, which is the coupon over the initial price that tells you what the current yield of the bond is, plus the rate of capital gain. So that's the change in price over the initial price that tells us what the capital gain is. Okay. So that's kind of a general equation. So when you think about bond returns in general, you want to take into account both the current yield, right? What is the coupon rate over what price you would have to pay to buy that bond today? And you might also want to take into account anticipated capital gains or losses. So there's a small distinction here between a realized capital gain or loss versus an unrealized capital gain or a loss. So if you actually end up selling the bond at the end of the year, and for whatever the current price, whatever the price of that bond is at the end of the year, then you have a realized capital gain or loss. So you actually went through with the transaction. Otherwise, you just have a paper capital gain or loss, or what we call an unrealized capital gain or loss. Okay. So the current yield and the yield to maturity, the reason why we might want to consider the total return on the bond is that the current yield or the yield to maturity don't take into account any potential capital gains or losses, right? It doesn't take into account that these bonds are trading on the secondary market with the price of the bond fluctuating, and that there could be a second source through which you could earn money on this bond or lose money on this bond. So that's the reason why we might want to calculate the total return on the bond rather than just relying on the current yield as a source of, to understand what the value of that bond is. Okay. So interest rate risk is this idea that the price of a bond will fluctuate based on the interest rate, right? To respond to changes in market interest rates, right? And the longer the maturity period of the bond is, the longer it is left for the bond to mature, the bigger the impact is of the change in market interest rates, right? So bond traders, if you're ever interested in bond traders or bond markets in general, uh, the interest rate, the market interest rate is a very closely watched metric in this entire enterprise, right? Because if that market interest rate changes, if the benchmark interest rate in the economy fluctuates, if it changes, that ripples through the prices of all the bonds which have been issued in the market, right? And the bonds which have the longer dated maturities are the ones which are the most affected by this, right? To see this in action, here's years to maturity, right? So this is the current yield, and I have all these uh, different scenarios here. Okay, so let's say there's these different bonds. They all have the same current yield, right? So they all are returning 5%. The face values are all the same, $1,000, and yeah, here we have the price at the end of the bond, right? So suppose the interest rate rises from 5% to 7%, right? The market interest rate is just going up from 5% to 7% during the first year of owning the bond. If there is only 1 year's maturity left on the bond, there is no capital gain or loss, right? Because it's not affected by the fact that there's a change in the interest rate, because there's only 1 year's maturity. It doesn't affect it, because at the end of the year I'll receive my 5%, and the other bond is, you have to wait an additional year from then on to receive the first coupon payment from it. So it doesn't make any difference. So at the rate of return on the for the year is still 5%. That's okay. But suppose there's 2 years of maturity left, right? It's the same bond, but now the price at the end of the year, because now there is a new bond which is going to yield 7% related to the 5% yield that the original bond exceeds, the price of the bond is going to fall for $981.31, which is to say now I have a capital gain, or I have a loss, right? I have a capital loss of negative 1.87%. And so the total rate of return for the year is the 5% coupon yield, the current yield that I receive, minus the capital loss of 1.8%. So for about a 3.1% total rate of return. But if it's a 10-year maturity bond, now the price is going to fall even more. So the price has fallen from to $869.70. So that's a negative 13% capital loss, and offset by the 5% current yield. So that's the total return is negative 8%. So what it generally is showing is that the longer the maturity of the bond is, the much more severe the impact of a change in the market interest rate is on the uh, total return of a bond, right? So that's one thing to take into account. So that's the reason why long dated securities are not very preferred, because they are subject, well, it depends on what your objectives are. I shouldn't make such a blanket statement. They're not that well, they're not preferred generally speaking, because of this reason, that if the market interest rates spike by even a small amount, go up or go down in either direction, then you might have like big fluctuations in the price of these bonds, because they are very long dated maturity bonds, right? So the thing with treasury bonds, right? So treasury bonds basically might have no default risk, which is that the risk that the US government will just stop making payments on these bonds is basically zero, but they might suffer from a huge degree of interest rate risk that just comes from the fact that the maturity of these bonds is so long, right? So in the next session, when we come back, what I want to show you, because it's just a general introduction into bond pricing. The next session will talk about all these maturity risks and interest rate risks and all of these in much more detail. Okay. Okay. A final thing that I want to talk about is this difference between the nominal interest rate and the real interest rate, right? So again, we need to this difference between nominal and real keeps coming back in economics over and over again. So the difference between nominal interest rates and real interest rates are that real nominal interest rates have not been adjusted for the fact that there's some expected inflation in the economy, right? So the real interest rate is a nominal interest rate adjusted for the fact that there exists inflation in the economy. So if you say that you know if if I buy a bond and the bond has a listed nominal interest rate of 10%, and if there is 8% inflation in the economy, my purchasing power has only gone up, right? The real interest is the real yield has only the real return I'm getting is only 2% because of that 10% return that I earn, which is the listed nominal interest rate on the bond. 8% of it, 8% is just taken away by the fact that prices have gone up by 8%, right? I'm just going to have to pay 8% more for everything in the economy to buy it. So even though I have 10% more money, prices have gone up by 8%. So really, my true return, the real return, is only 2%. And that's basically what it is, right? So the real interest rate here equals the nominal interest rate minus the expected rate of inflation, where R is I minus pi, where pi here is uh, the expected inflation rate. Okay. So if the inflation rate is greater than the expected, right? If they realized, right? If the realized inflation rate, because it's all done in expectation, because we don't know how much the price would go up by in the future. But suppose, um, the inflation, if the realized inflation rate is greater than the expected inflation rate, then the real interest rate will be less than the expected real interest rate. Right? So if I expect, okay, here's the thing. If our expectation is that inflation will be 2% next year, so a bond which yields a nominal interest rate of 5% has an expected real interest rate of 3%, right? 5 minus 2 is 3%. So the expected real interest rate on that bond is 3%. But suppose the realized inflation, the actual inflation was not 2% as we expected, but 4%. Now the real interest rate now would be 5%, which is a nominal interest rate, minus 4%, which is the realized inflation, which means that the real interest rate will be 1%. Okay? Which is to say the real interest rate will be 1%. If the real interest rate is lower than the expected real interest rate, then the borrowers will gain and lenders will lose, right? Because borrowers are essentially paying back less money than they expected to pay back, and lenders are getting back less money in purchasing power terms than they were expecting to make, right? So there is a huge amount of inflation risk associated with all of this activity. And it's the same thing, right? If the inflation rate, if the actual realized inflation rate is less than what was expected, then the real interest rate is higher than what it was expected. So the cost of borrowing for borrowers was higher than they was expected, so that they lose, and the return to saving was higher than what was expected, so savers gain, right? So that's the logic of all of this. So if I was expecting inflation to be 2% and it turns out inflation is 4%, then my cost of borrowing, then the real interest rate is only 1%. Suppose the nominal interest rate is 5%, right? So the real interest rate is only 1%. So borrowers are essentially cost of borrowing for, it seems like it's only 1% rather than 3%, while lenders who are expecting to make a 3% real interest rate uh, uh, on their lending are now only earning 1%. Okay. So here's a uh, thing here, we have some data from the Fed, right? So this is we're taking a look at the nominal interest rate in the US on a 3-month US Treasury bill, right? So shortest duration, shortest maturity US Treasury bill. And as you can tell, the blue line here is the nominal interest rate. The red line here is the purple line here is the real interest rate, and then the green line here is the expected real interest rate, right? So the actual real interest rate is just the nominal interest minus the actual inflation rate, right? The expected real interest rate is the nominal interest rate minus the expected inflation rate, and we have these things, right? So we want to make sure that these gaps between what the expected real interest rate and the realized real interest rate are, these gaps need to be as small as possible. And generally speaking, they track each other very, very closely. But if these big gaps open up, right, so this is a period where the real interest rate, right, is greater than the expected interest rate, right? So in 2006, the real interest rate is greater than the expected interest rate. This is a period where the borrowers will lose and lenders will gain. Right? So this is a period if the expected interest rate, if the expected real interest rate is lower than what it turns out to be, then this is a case where, like you were expecting to make 3% money on your on your lending. Instead, now you're making 5%. So suddenly, as the cost of borrowing has gone up significantly relative to what it was just before it. And this is what we saw at the height of the crisis, right? So everyone was expecting that the real interest rate would be only around, I don't know, 2.5%, but then the real interest rate spikes up. So every time there is a period of significant crisis in the economy, so this is 1990, 1991, there might be like this is kind of dislocation between what is the expected real interest rate and what is the actual realized real interest rate, and that those things can be exploited. Okay? So it's also possible for the nominal interest rate to be lower than the real interest rate. This is when the inflation is positive, right? When the inflation rate is negative, which is to say we have deflation, right? Generally speaking, the inflation rate is going to be positive. So if this pi is positive, then the real is always going to be lower than the nominal, because you're adjusting the nominal interest rate down by the magnitude of the expected inflation. But in periods of deflation where the prices are actually falling, then this entire thing is going to be negative. So the negative inflation, which means negative times negative is just going to be positive. So you might have cases where when you have deflation, that the nominal interest rate is lower than the real interest rate. Okay, and this is again from Fred. So in order to, now that you understand that inflation might affect what kind of returns you would get from your assets, there is a certain class of treasury bill which was introduced. Was introduced for the first time in 1996, I think, or 1997. Sorry, what is known as steps, right? So these are treasury inflation protected securities, which are basically treasury bonds which are indexed to inflation. So the interest rate on these bonds are pegged to inflation. So if realized inflation is higher, then the interest rate on these bonds goes up, and if the inflation rate is going to trend lower, then the interest rate on that is automatically adjusted down, right? So you can protect yourself. So there's some of these debt instruments into which, or debt contracts into which, these protections around changes to inflation are written into, so that given that it's a significant source of uh, variation, it generates variation between what you're expecting and what happens in reality, you can hedge against that risk using these kinds of instruments, right? So at the beginning of the chapter, we asked this question: so why do interest rates and prices of financial assets move in opposite directions? The answer is now straightforward, right? That brings us to the three key elements that we talked about. The first key element is that the price of a financial security is equal to the present discounted value of the cash flows that that security generates and what you get from owning that security. Given that is mechanically the case, if the interest rate on the security goes up, the price of the present values fall, and if the interest rate goes down, the present values go up, right? So mechanically speaking, just because of the way prices and of these instruments and are determined through this process of what we call discounting, just mechanically it follows that when interest rates go down, prices should go up, and when interest rates go up, prices need to fall. Okay? And that tells us that there's this inverse relationship between interest rates and the prices of financial securities. Okay, so that's basically it. That's where I'll stop for this particular session. So when we come back in the next session, we'll start talking about the term and risk structure of interest rates, and we'll go a little bit more in depth as in the treatment of interest rates. And we'll stick with this and bond pricing for another couple of sessions before we move on and start talking about stock valuation and the rest of it. Right. So if there's any questions, always let me know. Thanks for listening, and I will see you guys in the next one. Bye bye.